You know, in the world of banking, everyone seems to be obsessed with getting bigger, more complex, and more centralized. But what if I told you there's a Swedish bank that does the complete opposite? A bank with no budgets, no sales targets, and get this, no individual bonuses. And yet, it might just be one of the most stable and profitable banks on the planet. So today we're going to put on our investor hats and dig into Handelsbanken to see if this totally radical approach is actually a recipe for long-term success.
So here's the plan. First, we'll break down their unique model, what we're calling the Handelsbanken Way. Then, we'll see if the numbers actually back it up. After that, we got to look at the risks on the horizon. And finally, we'll bring it all together for the investor's verdict. All right, first things first. To really understand Handelsbanken as a potential investment, you have to get your head around its completely countercultural operating system. Seriously, this is the key to everything else. It all comes down to this one simple, powerful idea. The branch is the bank. Now, this isn't just some fluffy marketing slogan they put on posters. No, this is the fundamental organizing principle of the entire company.
So what does that actually mean? Well, in practice, it means an absolutely extraordinary level of autonomy. The local branch managers have the final say on who gets a loan and at what price. They are basically running their own little bank tailored to their own little community. All the decision-making power is pushed right out to the edge, right where the information lives, next to the customer.
And this is where it gets truly radical. They've literally thrown out the entire corporate playbook. There are no budgets dictated from some far-off headquarters. There's no pressure on employees to hit monthly sales targets. And most importantly, there are no individual bonuses, which the bank believes create all sorts of toxic, short-sighted incentives.
So you might be asking, well, what drives performance then? It's actually super simple. The goal is just to be more profitable than their competitors. And if the bank as a whole achieves that, every single employee from the CEO to the teller gets an equal share in a collective profit fund called autonomy. It perfectly aligns everyone toward the same long-term goal. And check out the risk control. This is genius. The policy for lending is set centrally and it's super rigid. But the decision on any specific loan, that's made locally. It's this perfect marriage of central discipline and local insight.
Okay, this all sounds great in theory, right? It's a nice story, but as investors, we have to ask the big question. Does this unique culture actually deliver the goods? Does it lead to superior financial results? Let's see what the numbers have to say. Okay, this right here is just stunning. For 6 quarters in a row, the bank had what are called net recoveries. That means they actually collected more cash from old bad loans than they had to set aside for potential new ones. In the banking world, that is almost unheard of. It's just incredible proof of the quality of their lending.
Now let's put them up against their big Nordic rivals. Their performance is really impressive. Take their cost-to-income ratio. That's a key measure of efficiency, and they are pretty much best in class. Then you look at their CET1 ratio, which is just a fancy way of measuring their financial strength, and it's like a fortress. Bottom line, they are profitable, they are lean, and they are exceptionally well capitalized.
And will you just look at that proposed dividend for 2024? That jump is insane. This isn't just a routine payout, folks. This is a massive signal of management's confidence. They are so sure about the stability of their business that they're planning to return an enormous amount of capital right back to shareholders.
Okay, so the picture seems pretty rosy so far, but a smart investor always looks for the risks. So let's shift gears and focus on the headwinds that could really challenge this amazing track record.
I mean, sure, the model has worked for over 50 years, but is it really built for the future we're heading into? That's the real question. Let's break down the threats.
So the first big risk is concentration. Just look at their loan book. It is overwhelmingly tied to property. We're talking mortgages, corporate property financing. It all adds up to nearly 90% of their lending. Now, their underwriting is obviously superb, but it means Handelsbanken's fate is directly tied to the health of the property markets in Sweden and the UK. If those markets catch a cold, this bank is in trouble.
The second big one is the digital challenge. Handelsbanken's entire brand is built on personal, human relationships. But let's be real, customers today expect the slick, seamless convenience of a fintech app on their phone. So the question is, can the bank modernize its tech without destroying the very culture that makes it so unique and successful? That is a really delicate balancing act.
And finally, you've got the big macro stuff that's totally outside their control. Central banks are starting to cut interest rates, and that directly squeezes their profit margins. A recession in Sweden or the UK would obviously hurt loan demand. And of course, the ever-rising costs of regulation are a constant drag on the bottom line. These are serious industry-wide headwinds.
All right, let's bring it all home. We've seen the unique model, we've seen the stellar performance, and we've looked hard at the clear risks. So how does this all come together into a coherent investment thesis?
This, right here, gets to the absolute heart of the investment case. Look at the price-to-book ratio. It's a key way to value banks. Even with its superior risk profile and incredible asset quality, Handelsbanken actually trades at a notable discount to its peers. The market seems to see the quality, but for some reason, it's not willing to pay a premium for it. And the big question is, why?
The bull case is pretty clear. First, that valuation gap could close as the market wakes up to its durable model. Second, they can use their incredibly trusted brand to grow their wealth management business. Third, if they can get their UK operations to be more profitable, that's a huge opportunity. And last but not least, you just can't ignore a forward dividend yield of over 12%. That's massive.
But of course, the bear case is just as straightforward. Falling interest rates are a direct and immediate hit to their earnings. That huge concentration in real estate makes them super vulnerable to a property downturn, and their conservative, fast follower tech strategy could easily lead to them getting left in the dust by more agile competitors. So, we're left with this one big question. Is Handelsbanken just a boring, old-fashioned relic, an anachronism in a fast-paced digital world, or is its unwavering focus on prudence, stability, and genuine customer relationships a timeless and maybe even brilliant investment in a world that seems obsessed with short-term thinking? That, ultimately, is for you to decide.